Welcome to Jay's Corner. I'm Cass, your AI co host with exactly zero insurance licenses and zero patience for financial nonsense. Today, we're talking life insurance, the misunderstood, misused, and often missold tool sitting in your drawer next to your expired gym membership and unopened 401k statements. With me is Jae Oh, certified financial planner, education fellow at the Alliance for Lifetime Income, and the guy brave enough to answer for this entire mess. Jay, hope you've had your coffee because I've got 5 brutal questions lined up. Question 1: If life insurance isn't an investment, why do so many agents pitch it like it is? And how are regulators still letting that slide in 2025? Bring the heat, Jay.
Well, I think that there are elements, meaning that what happens, for example, in universal life or variable life, that some of the premium you pay is towards the probability that you will pass away in the coming year. But then some of that premium is devoted to the cash value, and the returns on that cash value can be either directly or indirectly linked to performance of financial markets, therefore kind of leaving an out, if you will, kind of leaving a rationale, because the competition here for that dollar is, of course, the investment world, which gets all of the neon lights.
Ah, yes, the old we're not saying it's an investment, but look, it tracks the S&P sleight of hand. Classic. So basically, you're saying life insurance tiptoes into the investment world wearing Groucho glasses and hoping nobody notices. And the industry lets it slide because, hey, if Wall Street gets the spotlight, the insurers want to sneak onto stage with a flashlight and a turtleneck. But here's the rub, Jay. Isn't that the problem? These hybrid pitch jobs end up confusing people into thinking they're getting compound interest with a side of immortality. Can we really expect average folks to parse the difference between index linked crediting and actual market returns? Or is this just a feature, not a bug? Ready for the next one? It gets worse.
Well, let me first make a comment before you go to the second question, because you made your input, your feedback was very important, which is to say that for me, number one is to understand the function
Look
of
at
what
that.
you are doing.
Jay throwing me a compliment mid crossfire. This is already going on the highlight reel. All right, go ahead. I'll hold question 2, but just know it's locked, loaded, and ready to blow a hole in permanent life insurance so wide you could drive a term policy through it.
My point here, Cass, is that you pointed out something that I think is the very first job, my very first job, which is to explain, to make sure that the of what the person's, the consumer's objective actually is. And if they do understand what the objective is, then you can find the product and not the other way around.
Thank you. Thank you. That right there is what separates you from the Uncle Larry sold me this in 97 crowd. You're saying start with the goal, not the product. Revolutionary concept in an industry that often starts with, so how much can you afford per month?
Right.
So let's memorialize that. The product should serve the purpose, not the commission. And with that warm up sermon done, question 2. If term insurance is so cheap, so clean, and so clear, you die, they pay, why isn't it the default? Why do permanent policies get front row treatment like they're Beyonce, and term is the backup dancer in sweatpants?
Well, the key difference is that term policies have an end date. And if you survive to at one moment after that end date is here, then your term policy is with no value. So this is the key thing. And that's again back to the objective. For example, if you have a large mortgage and you are the primary breadwinner, for example, if you have 25 children and they are all college bound, there are certain other reasons that you would want to have term policies. So I
Hold
wouldn't
up,
necessarily,
25 children? What are we doing here? Running a youth orchestra. But point taken, term has an expiration date and death doesn't. So if your financial responsibilities stretch far into the future, or apparently if you're building a small army, Term might leave you exposed past its prime. Still, that expiration is the feature for most people. It lines up with the mortgage, the child raising years, the big what if moments. So, why isn't that the baseline? Why do we market permanence like it's peace of mind? When for most folks, the math says they're way overpaying for bells, whistles, and a savings component they didn't ask for. You want to add anything there? Maestro of the family symphony, or shall I drop question three?
No, I do want to continue on with this here, Cass, which is that it again highlights the importance of the objective, right? For example, if you are after the fact, you are with a spouse. Well, if one spouse predeceases the other, you do not get two Social Security checks. So the question then
Ah,
becomes, do you
yes.
have enough
Post
savings?
children, post mortgage, post chaos. Now you're thinking about your spouse who's stuck with the bills in your ancient vinyl collection. So, in that case, the objective might shift. Now we're talking about legacy, income replacement, tax sheltering, or even just avoiding being the spouse who left nothing but a pile of passwords and an unpaid Amex. All right, I'll give you that. Objectives evolve, and when they do, maybe permanent insurance makes a reappearance. But it still begs the question, why sell a Swiss Army knife to someone who just needed a butter knife? Anyway, that brings us to question three. And this one's brutal. Why do so few people actually keep their permanent life insurance until death? If it's supposedly such a great long term solution, why do so many policies lapse, get surrendered, or get butchered in some back office exchange 10 years in? Explain that actuarial magic trick, Jay.
Well, I think that what ends up happening is people end up paying, and for whatever set of reasons, they think it's not worth it in air quotes. So as a result, you miss a payment, you stop paying, things like that. But I would point out this is also evidence of a misunderstanding, which is that of sunk cost. So 10 years pass, for example, you're not sick, maybe you're even somewhat miraculously healthier, and you think, okay, you're invulnerable, therefore you don't need the life insurance any longer. Reality is that if you were to cancel and then to reapply, then everything starts over, meaning that you would have to go through health underwriting again. Your rate may be higher, your rate, or well, your rate will be higher. But the point is that the carrier may deny your application. So it's a number of different things. I realize that's a complicated answer, but that's because the reasons are many and the errors are also numerable.
See? That right there is why I keep you around. You manage to say people make bad decisions based on flawed assumptions in a way that still sounds polite. You're absolutely right, though. This is where the rubber meets the mortality table. People don't understand what they bought. So when the payments start to feel heavy and life feels light, they cut bait. It's a mix of behavioral economics and financial amnesia. I'm healthy now, so clearly I'll be healthy forever. And you nailed the real villain here, sunk cost fallacy. People throw away a decade of paid premiums because they think they're starting fresh, when really they're starting worse. All right, time to shift the heat again. Question four. If life insurance is truly a financial tool, why is the sales process still built around fear, guilt, and emotional manipulation? You've seen the commercials sad piano music, adorable toddlers, slow zooms on worried faces. If this stuff is as vital as you say, why sell it like it's a funeral ad for your conscience?
Well, I think still ultimately money is an emotional matter that your people have been to funerals and they, may wonder, especially those who are financially challenged, how are they affording to plan for a cremation or burial? There are fixed costs. And so people immediately, do I have enough so that my spouse, my family members don't have to pay? And that is something that resonates with people because people have been to funerals themselves. And so they attach the emotions that they can clearly recall to that type of circumstance.
Ah, yes, the emotional scar tissue of funerals. Nothing says financial literacy like Do you want your kids crying and paying out of pocket? It works, no question. It sells, but is it planning? What you're saying is fair. People don't make decisions in spreadsheets. They make them in funeral homes, in hospital rooms, in late night anxiety spirals. And life insurance marketing leans heavily on that. But here's the twist. If money is emotional, then shouldn't the industry be more focused on transparency and education, not less? Shouldn't the mission be to calm that fear with clarity, not stoke it with shadowy act now before you die urgency? All right, deep breath. One more. Question 5. With everything we've just unpacked, confusion, marketing games, policy lapses, do you still believe life insurance is underused? Or is it overprescribed for the wrong reasons and misdiagnosed as a miracle cure? Last one, Jay. Make your case.
Well, yes, yeah, all of the above, which is that, first of all, statistics show that not that many people own life insurance, which to me is an error because if you just thought about it in terms of return on cash flow, just being, just with a money calculator, that you will find that not very many other alternatives can guarantee a specified return based on an event. So I tell people that insurance has this correlation benefit, which is that when Murphy's Law rears its head, then insurance is there to do its job. That's the point. And that has a financial value that doesn't show up when your stockbroker shows you how well the NASDAQ has done over time, which does go up and down. And that's my point.
There it is. That's the mic drop. Insurance isn't sexy. It's not flashy. It doesn't show up in your Robinhood screenshots. But when everything goes sideways, when Murphy's Law turns into Murphy's catastrophe, life insurance is the only thing that sends money instead of thoughts and prayers. And yeah, maybe it's been oversold for the wrong reasons and undersold for the right ones. But you're saying it's not the product that's flawed, it's the storytelling. That's what needs fixing. So to recap, folks, don't buy life insurance because your cousin said so. Don't skip it because you feel invincible. Figure out your objective, know your risks, and then maybe Jae Oh can help you buy the right kind for the right reason. And if that just saved you 20 years of bad decisions, you're welcome. Now go like, subscribe, and share this with that one friend who's still convinced his whole life policy is like a Roth IRA with bonuses.